You're watching Investing 101 by 𝐵&G Incorporated. Do-it-yourself investing. The question of how to invest boils down to whether you are a do-it-yourself (DIY) kind of investor or would prefer to have your money managed by a professional. Many investors who prefer to manage their money themselves have accounts at discount or online brokerages because of their low commissions and the ease of executing trades on their platforms. DIY investing is sometimes called self-directed investing, and requires a fair amount of education, skill, time commitment, and the ability to control one's emotions. If these attributes do not describe you well, it may be smarter to let a professional help manage your investments. Professionally managed investing. Investors who prefer professional money management generally have wealth managers looking after their investments. Wealth managers usually charge their clients a percentage of assets under management (AUM) as their fees. While professional money management is more expensive than managing money by oneself, such investors don't mind paying for the convenience of delegating the research, investment decision-making, and trading to an expert. Robo-advisor investing. Some investors opt to invest based on suggestions from automated financial advisors. Powered by algorithms and artificial intelligence, robo-advisors gather critical information about the investor and their risk profile to make suitable recommendations. With little to no human interference, robo-advisors offer a cost-effective way of investing with services similar to what a human investment advisor offers. With advancements in technology, robo-advisors are capable of more than selecting investments. They can also help people develop retirement plans and manage trusts and other retirement accounts, such as 401(k)s. You can choose the do-it-yourself route, selecting investments based on your investing style, or enlist the help of an investment professional, such as an advisor or broker. Before investing, it's important to determine what your preferences and risk tolerance are. If risk-averse, choosing stocks and options may not be the best choice. Develop a strategy, outlining how much to invest, how often to invest, and what to invest in based on goals and preferences. Before allocating your resources, research the target investment to make sure it aligns with your strategy and has the potential to deliver desired results. Remember, you don't need a lot of money to begin, and you can modify as your needs change. There are many types of investments to choose from. Perhaps the most common are stocks, bonds, real estate, and ETFs, mutual funds. Other types of investments to consider are real estate, CDs, annuities, cryptocurrencies, commodities, collectibles, and precious metals. Investing is not reserved for the wealthy. You can invest nominal amounts. For example, you can purchase low-priced stocks, deposit small amounts into an interest-bearing savings account, or save until you accumulate a target amount to invest. If your employer offers a retirement plan, such as a 401(k), allocate small amounts from your pay until you can increase your investment. If your employer participates in matching, you may realize that your investment has doubled. You can begin investing in stocks, bonds, in mutual funds, or even open an IRA. Starting with $1,000 is nothing to sneeze at. A $1,000 investment in Amazon's IPO in 1997 would yield millions today. This was largely due to several stock splits, but it does not change the result: monumental returns. Savings accounts are available at most financial institutions and don't usually require a large amount to invest. Savings accounts don't typically boast high interest rates, so shop around to find one with the best features and most competitive rates. Believe it or not, you can invest in real estate with $1,000. You may not be able to buy an income-producing property, but you can invest in a company that does. A real estate investment trust (REIT) is a company that invests in and manages real estate to drive profits and produce income. With $1,000, you can invest in REIT stocks, mutual funds, or exchange-traded funds. No, gambling and investing differ greatly. With investing you put your money to work in projects or activities that are expected to produce a positive return over time, they have positive expected returns. Gambling is to place bets on the outcomes of events or games. Your money is not being put to work at all. Often, gambling has a negative expected return. While an investment may lose money, it will do so because the project involved fails to deliver. The outcome of gambling, on the other hand, is due purely to chance. Whether buying a security qualifies as investing or speculation depends on three factors: the amount of risk taken on. Investing usually involves a lower amount of risk compared with speculation. The holding period of the investment. Investing typically involves a longer holding period, measured quite frequently in years. Speculation involves much shorter holding periods. Source of returns. Price appreciation may be a relatively less important part of returns from investing, while dividends or distributions may be a major part. In speculation, price appreciation is generally the main source of returns. As price volatility is a common measure of risk, it stands to reason that a staid blue chip is much less risky than a cryptocurrency. Thus, buying a dividend-paying blue chip with the expectation of holding it for several years would qualify as investing. On the other hand, a trader who buys a cryptocurrency to flip it for a quick profit in a couple of days is clearly speculating. Don't forget to like our videos, share them with your friends, subscribe to our YouTube channel and hit the bell icon to get notified whenever we post a new video. Thank you for watching Investing 101 by 𝐕𝐴NG Financing Incorporated.